Financial markets are dynamic. They constantly fluctuate, driven by a multitude of factors. Understanding these fluctuations is key to successful investing. This is where market cycles come in. Market cycles represent recurring patterns of upswings and downswings in asset prices. By recognizing these cycles, investors can make more informed decisions, maximizing returns and minimizing risks. Think of market cycles like the seasons. Just as spring follows winter, periods of market growth follow periods of decline. Each phase presents unique opportunities and challenges. By understanding these phases, investors can position themselves for success. Ignoring them can lead to costly mistakes. Remember, market cycles are not about predicting the future. Instead, they provide a framework for understanding market behavior and managing risk. If you're finding this information valuable, please take a moment to hit the like button and subscribe to our channel. By aligning your investment strategy with these cycles, you can navigate market volatility with greater confidence and achieve your financial goals. The accumulation phase marks the beginning of a new market cycle. This is a critical period where the foundation for future gains is laid. Understanding this phase can be the difference between mediocre returns and substantial profits. This phase typically occurs after a period of significant market decline, often referred to as a bear market. During a bear market, prices of assets fall sharply and investor confidence is shaken. Investor sentiment is generally low, and fear often dominates the market. The media is filled with negative news, and many investors are gripped by panic. Many investors are hesitant to invest, fearing further losses. The trading floors are quieter, and the volume of transactions is lower as people wait on the sidelines. However, this is where astute investors find opportunity. They see beyond the current gloom and focus on the potential for recovery. Asset prices are often undervalued, offering attractive entry points for long-term investors. These investors understand that buying low is the key to future profits. While the market may still be volatile, the worst of the decline is typically over. The initial panic has subsided, and the market begins to stabilize. Smart investors begin accumulating positions in undervalued assets, laying the groundwork for future profits. They are guided by research and a long-term perspective. Think of it like buying a winter coat on sale in the spring. The demand is low, but the value remains. The demand is low, so the prices are discounted. This is the perfect time to buy quality items at a fraction of their usual cost. Similarly, during the accumulation phase, the fear and uncertainty in the market create an opportunity to acquire assets at bargain prices. This is when savvy investors make their moves. This phase requires patience and discipline, as it may take time for the market to turn around. Investors must be willing to wait and not be swayed by short-term fluctuations. The accumulation phase is not about timing the absolute bottom of the market. Trying to catch the exact bottom can be a futile exercise. Instead, it's about recognizing the potential for future growth and taking advantage of attractive valuations. Investors look for signs that the market is beginning to recover. By patiently accumulating assets during this phase, investors position themselves to reap the rewards of the next market upswing. They build a portfolio that is poised to benefit from the eventual market recovery, ensuring they are well positioned for future gains. As the market begins to recover, we start to see the first glimmers of hope. The initial signs of recovery are often subtle, but they are crucial indicators that the market is shifting gears. Investor sentiment gradually shifts from pessimism to optimism. This change in attitude is not just a fleeting moment. It is a fundamental shift that sets the stage for the next phase of the market cycle. This marks the beginning of the markup phase, characterized by rising asset prices and increasing market participation. During this period, the market experiences a robust upward trend, and the overall economic outlook becomes more positive. More investors recognize the upward trend, and demand for assets begins to outpace supply, driving prices higher. This surge in demand is often fueled by a combination of improved economic indicators and growing investor confidence. This phase typically witnesses a self-fulfilling prophecy. As prices rise, more investors are drawn into the market, creating a cycle of increasing demand and rising prices. As prices rise, more investors jump on board, further fueling the upward momentum. This creates a sense of euphoria and excitement, as everyone wants to be part of the winning trend. This creates a positive feedback loop, often leading to significant market gains. The more the market rises, the more investors are encouraged to invest, perpetuating the cycle. The markup phase is generally characterized by increased trading volume, as investors actively buy and sell assets. This heightened activity is a clear sign that the market is in a strong upward trend. During this phase, it's important to stay invested and ride the wave of market growth. However, it's equally important to remain vigilant and not become complacent. However, it's also crucial to monitor your investments closely and adjust your strategy as needed. Regularly reviewing your portfolio and making necessary adjustments can help you stay on track and maximize your returns. As the market climbs higher, valuations may become stretched, increasing the risk of a correction. It's essential to be aware of these risks and to have a plan in place to mitigate them. The key to success in the markup phase is to balance greed and fear. While it's tempting to chase after every opportunity, it's important to remain disciplined and not overextend yourself. Don't get caught up in the euphoria and overextend yourself. Overextending can lead to significant losses if the market takes an unexpected turn. At the same time, don't be afraid to let your profits run. Allowing your investments to grow can lead to substantial gains over time. By staying disciplined and sticking to your investment plan, you can maximize your returns during this exciting phase of the market cycle. Diversification and regular portfolio reviews are key strategies to ensure long-term success. Section 4. Shifting Sands. The distribution phase. After a period of sustained growth, the market typically enters the distribution phase. This phase marks a transition period where the market's upward momentum begins to slow. Investor sentiment becomes more mixed, with some investors taking profits and others remaining bullish. The distribution phase is often characterized by increased market volatility and a widening trading range. Asset prices may fluctuate significantly, making it difficult to predict short-term market movements. This uncertainty can create anxiety for investors, as the market's direction becomes less clear. During this phase, it's crucial to be more cautious and selective with your investments. Avoid chasing after hot stocks or sectors that have already experienced significant gains. Instead, focus on preserving your capital and protecting your profits. Consider gradually reducing your exposure to overvalued assets and raising cash. This will provide you with greater flexibility and liquidity to take advantage of any market dips or opportunities that may arise in the next phase. The distribution phase is a time for prudence and patience. Section 5. The storm breaks, the markdown phase. The markdown phase represents the final stage of the market cycle. This phase is often the most challenging and stressful for investors, as it signifies a period of sustained decline in asset prices. It is characterized by a sustained decline in asset prices, often accompanied by negative investor sentiment and panic selling. The atmosphere during this phase is typically one of fear and uncertainty, as investors scramble to protect their capital. During this phase, the market's upward momentum reverses, and prices begin to fall, often rapidly. This sudden shift can catch many investors off guard, leading to a cascade of selling as they attempt to cut their losses. Investors who failed to recognize the warning signs of the distribution phase may find themselves caught off guard. The distribution phase, which precedes the markdown phase, is often marked by subtle signs of weakening market strength that can be easy to miss. Fear and panic can drive investors to sell their holdings at any price, further accelerating the decline. This panic selling can create a self-fulfilling prophecy, where the fear of losses leads to even greater losses. The markdown phase can be a challenging time for even the most seasoned investors. It tests their resolve and their ability to remain calm under pressure. However, the markdown phase also presents opportunities for astute investors. Those who can keep a level head and analyze the market objectively may find valuable opportunities to buy assets at a discount. As prices fall, valuations become more attractive, creating potential buying opportunities for those with a long-term perspective. This is a time when patience and careful analysis can pay off handsomely. This phase is not a time to panic. Instead, it is a time to reassess your portfolio and make strategic decisions. Instead, it's a time to reassess your portfolio and look for opportunities to buy undervalued assets. Consulting with a financial advisor can provide valuable insights and help you navigate this turbulent period. Remember, market cycles are cyclical. The downturns are a natural part of the market's ebb and flow. Just as spring follows winter, a new bull market will eventually emerge. The key is to remain patient and prepared for the recovery. By staying calm and disciplined during the markdown phase, you can position yourself to capitalize on the next market upswing. This approach not only helps preserve your capital, but also sets the stage for future gains when the market rebounds. For more informative videos like these, please hit the like button, share, and subscribe. Rules the market. Become a stock lord.